Hello and welcome to Livewire. My name's Tom Richardson and today I'm sitting down with Nate Walton, a partner at Ares and head of its private equity secondaries. Nate, welcome.
Thank you.
Okay, so a lot of people will have heard about private equity investing, but can you just tell us what it is and why investors should consider allocating to it?
Yeah, sure. Private equity is an asset class that's been around now for probably close to 50 years, and it's really defined by when an investor owns the company in the private markets versus in the public markets. And so you generally have one shareholder who has, absolute control and governance over that company. And the private markets are a huge market opportunity. We estimate there's approximately 200,000 companies in the US private middle markets. Compare that to just under 5,000 in the public market. So you have 99% of the companies that are in the addressable universe for making investment opportunities to be in the private market versus the public market. And there's lots of reasons why, in our opinion, that governance model, that alignment with shareholders, that optimizing of profit for the company has really led to long-term outperformance of the private equity asset class.
Okay, and the current market backdrop, is it more challenging or beneficial for PE value creation?
I'd say it's probably more beneficial. If you think about market environments, the public markets generally do well when the tailwinds are in their favor. And so when you have rising markets because of quantitative easing and lower interest rates, all those things, kind of flow their way through the public markets and they benefit. But in periods like we're going through right now, where it may be a little bit more choppy or the go-forward returns in the macro environment may be a little bit harder to generate, that's where the importance of the day-to-day blocking and tackling that happens in these private companies becomes even more important to generate the equity returns that investors are looking for.
And can you give us some detail about private equity secondaries and why they matter?
Sure. The private equity secondary market really was formed about 40 years ago, so about 10 years after the private equity industry was formed. And the reason it was formed is pretty simple. Private equity is an illiquid asset class. And what I mean by that is you can't pick up the phone and sell stock or buy stock in these companies. So if you're an investor in a fund, and these funds have 10-year lives or 15-year lives to buy a company, fix a company, and then sell a company, some investors, for a variety of reasons, decide to sell their interest in a fund prior to the end of the fund life. And so the secondary market was evolved to help support the liquidity needs of those investors. But what it's created is a really good entry point for investors to access private equity, because you come in after the companies have already been identified. You come in generally 3 to 4 to 5 years into a fund. And importantly, you're generally able to buy at a discount to what is called the net asset value of the fund. So you come in after the assets are identified and at a discount, and therefore your risk proposition is generally lower, but your return expectation can be similar to what you'd get if you had been in the fund from the beginning.
How does Ares distinguish itself from other secondary managers?
So one of the things we do differently than our peers is we take the entire Ares management platform, which today is over $500 billion of assets, a global manager, and we take that opportunity set that we see in the middle market, particularly with private companies, and we use that information to help us make better decisions. And specifically what we do is we use our credit business, our direct lending business, which we believe is one of the largest direct lenders in the world, covering over 3,000 investment opportunities per year. They see pretty much all the opportunities in the private markets. And so what we do as a secondary investor is we work with our direct lending colleagues to make decisions about which companies to invest in, which funds to buy. And that's a huge competitive advantage that unless you had a very large alternative asset management firm like ourselves, you wouldn't be able to get that access to information.
And if we look to the future, what's the opportunity for private equity secondaries?
We're quite bullish on the opportunity for private equity secondaries. I think the reason is as the private equity market has continued to grow over the last 5, 10, 15 years, and we expect that growth to continue maybe at a moderated pace, the need for liquidity is always going to be there, because you have investors in these funds. The average is about 2% every year of all of the investors in that fund or the private markets would look for what they call as a liquidity solution. We call that the turnover ratio in secondaries. Well, private equity has gotten so big that number is now up to about $150 billion a year of transaction volumes because of the sales that are happening as investors go to monetize their positions. And there's only 5, 10, maybe 15 buyers in the entire world for the private markets who can step in and provide that kind of liquidity at any kind of scale.
How does that show up in the cash flows for the secondary investor?
If somebody who makes an investment into a regular private equity fund, they make their commitment to the fund at the beginning of the fund life, and over years 1, 2, 3, and 4, generally they'll be asked to invest about 25% of their commitment in each of those 4 years. That's the average funding of a profile of a private equity fund. A secondary investor will oftentimes buy in year 4, 5, or 6 after those capital calls have all been made. So what that means for the secondary investor is they get to invest 75, 80% of their money at once, but more importantly, they start to get their cash flows back to themselves, usually within years 1, 2, and 3 after making their investment. So their average hold period on their investment is probably somewhere between 3 to 5 years. You compare that with the primary investor of a private equity firm who makes 4 years to make their investments and then receives their cash flow over the following 4 years. Their hold period can be closer to 5 to 7 years to get the return of their capital. So you have a much more accelerated return of cash as a secondary investor because of when you came into the fund.
If you like that video, please visit livewiremarkets.com and subscribe to our YouTube channel.